Welcome back, dear viewers. Now, more people today are thinking about investing and looking for ways to build a stronger financial future. But before asking where to invest, perhaps the most important question is, are we all financially ready to invest in the first place? And now to help us understand how to approach investing responsibly, of course, we're joined by Ammar Alkandari, investment and personal finance educator. Ammar, thank you for joining us here on Good Morning Kuwait.
Good morning, and thank you for this invitation.
Thank you. Now, I think for a lot of people, financial investment is something they want to get into. And we've seen that in recent years. We've seen a lot of interest in people trying to get into, investing, trying to get into, stocks markets, trying to get into all of this. Can you tell us about a little bit more about what's driving this trend?
Bismillah ar-Rahman ar-Rahim. Yes, of course, it is a very positive thing that people are going into the investing. They are become more financially aware into their money. And I believe what driving this trend is that inflation become more noticeable to people. Even if some people don't know what inflation is, they are noticing it by seeing that the prices are coming higher and higher non-stop. So they want to keep up with that by investing. Also, the AI trend is doing his job, and AI companies introduce themselves to people by saying we are the future, and no one wants to miss that. We call it FOMO. It is fear of missing out. So because of that, I believe that everyone have to invest. The question is not, am I ready to invest or not? I think the real question is, how can I invest? Even if you have a low or high income, you have a job or you are a student, you have to invest. You have to invest at least with a small amount monthly of money. It's better than nothing. At least you will keep up with the inflation, and in some points, maybe you will beat the inflation. And this is our goal from the investment.
Yes, and of course, when talking about a lot of things about investments and everything, whether it's related to the stock market or brokerage or anything, they say time in the market beats timing the market. So for a lot of people who are waiting to feel that readiness to want to get into investing, how can they know or how can they decide when it's the right time to invest?
I always said, and actually investors said, that the best time to invest was from 20 years ago. But the second best time to invest is today. So you can start from today investing, but before that, we have to check up for your loans or debts. If you have debts, it is the first priority, financial priority that you have to do from today is to pay off your debts. We can use the method, we call it a snowball method. What you have to do is saving a small amount of money from your income and try to pay off your smallest debt. And when the payment come out to you, you take this payment plus the money that you are already saving before, combine them and close the next smallest debt until you close all your debts. If you don't have debts, and for some people, if your debts don't bothering you financially, you can skip this part and go directly to investing. You can invest in gold, silver, or stock market, any financial, any assets that you prefer.
It is. And mashallah, I think we can all say, if you don't have any debt, mashallah alaykum, we kind of feel jealous, from you. But honestly, I think this is something, the phrase you said earlier, the best time was 20 years ago, the second best time is now. I've heard that so much, right? Because, like you said, the fear of missing out, people see the high prices and they want to go in. They follow these emotions, they follow a lot of these reactions. So how can people invest, but with careful planning instead of following emotions?
Controlling your emotions is one of the key skills that you have to learn with your journey investing. Benjamin Graham, the author of Intelligent Investor, which I recommend everyone to read this book. It's a very important book. He said once, successful investor who keep the emotions in the back seat. So we can do, before start investing, to control your emotion, you have to do a clear plan. It is a simple plan. It is not complicated. It is about several things. First of thing, you have to decide what amount of money you have to invest monthly, and how long is the period you want to stay in the market. And last thing, you have to decide and choose which asset are you comfortable with: gold, silver, asset, real estate if you have. It depends from person to another. So when you do this clear plan, stick to it. You have to be patient and disciplined. Peter Lynch, the author of One Up on Wall Street, which is also a very excellent book, he said once,
I think when it comes to the fears, a lot of people have, it's better to go to a lot of books that you're referencing to get the knowledge from them.
Yes, reading books is very important, especially in investing. As I said, Peter Lynch once said that. Actually, I forget I forget the quotation,
Yeah.
so I will skip this part.
No, it's fine.
Okay, so you have to put a plan and decide what to do, and be patient and disciplined to this plan. Peter Lynch said that investing have to be boring. If you are not boring, you are not in the right place. So you have, because the investing reveals after years and years. The profit of it reveals years and years, not directly, not from first or second month. So you have to be patient and disciplined to your plan.
It is. I think, being patient is the key word here. And also for a lot of people, to be able to take the losses. Because I remember when me and my group of friends, when we first tried to invest, and this is like many years ago, I think we were losing like maybe 2 or 3 KDs, and we were all crying. So you have to be able to take, the losses, of course, magnitude by so many. Now, when it comes to personal savings, whether it's a bank loan, a business partnership, choosing the right path for you is always a very integral part of the process. So how can people choose what is to invest in? How, the correct decision to make?
This is one of the biggest mistakes that I always tell people not to do, is that they take loans and they have debt to invest. Don't do that, because when you take loans, you are starting minus, and your goal to reach the 0 point. Why would you do that? So just start small, step by step. Even small amount of money monthly, it is way much better than taking loans and investing it.
It is, and mashallah, this reminds me of, again, my group of friends who are all broke. They said we're going to take maybe 60,000, 50,000 KD loan and then to invest in it. Like you said, you have to make another 50,000 to reach,
yes,
0 point.
To reach the 0 point.
Yeah.
Your goal is to reach the 0,
Yeah.
so don't do that.
So
Just
in small increments.
Small amount of money monthly is way better.
It is, and now, of course, when it comes to investing, there are so many options. There are so many, companies, so many, stocks, so many assets, so many, gold, silver, oil, the price, the cement. How can people know, or if they're trying to invest something, to see the warning signs of the thing they're investing in?
We have a small rule here. The higher the expected returns, the higher the risk. So if you decide to invest in small stocks or in Bitcoin, for example, because you are expecting high returns, you have to know that you are in a high risk also. There is a solution for that. We can balance our portfolio. It's a one simple rule. Don't invest all your money in one asset. If you want to invest in stock market, for example, choose 5 to 10 big companies. Each one is in a different industry and in the different sectors. Like this, you have a balanced portfolio that will stand against the market, and you can add some golds in the future for your portfolio to have a safer assets in your portfolio. In this way, you will have a balanced portfolio that will stand against the market. The market also, if there is a crash on the market, it will stand against it on the long period of time.
Yes. And honestly, it's always it's always best to take precautions and safety instead of a lot of high risk. Now, when it comes to you're somebody who has invested now, you're staying for the long game. What are something that you should be paying attention to across time?
People should review and monitor their investment, but not too often, because we don't want the daily news make you make bad decisions or random decisions because of the fear and greed emotions that you take from this daily news. I believe that once or twice a year it's more than enough to review your investment. If you invest in gold or silver, you never review your investment. Just go ahead, just keep going. But if you invest in stock market, maybe there is some financial statement you have to pay attention to. First one is growth in revenues. The company have to growth in their revenues years over years. Second, maybe we can check the net income, because we want to know that is the company in loss or profit. Maybe the free cash flow for the company to know that the company are making money or not. And we can check the assets and the liabilities for the company. And I will be honest, at this point, I believe that this question is very challenging because in my course, I took 2 to 3 hours answering this question for my audience.
We don't have to.
Yeah, I know that. But this is the very quick checklist that you can do. Growth of revenues, net income, free cash flow, assets and liabilities as a quick review.
It is. And mashallah, you know, you've said it so eloquently, I would say, and so, you know, I'd say at best possible. I think, you know, for me to tell my group of friends is that don't look at the day and, you know, today, tomorrow, the week after, the losses and gains. Look at it from year to year. Yes. That's how you judge true profit.
The long period.
The long
because markets always in high and positive trend in the long period of time. Yeah. Don't look at today and yesterday's lost all profit.
It is. Now, of course, sometimes for a lot of young people who are getting into the job force, you know, who are receiving their first monthly salary after 3 months of working without any salaries, you know, can you tell them, you know, a financial plan or an investment plan that is very good for them at their, you know, appropriate levels of investment?
Yes, thank you for this question. It's a very important question. For the map that I will give. First, we will divide our salary or our income into at least three parts. I prefer 4 parts. I will tell you why. The 4 parts will be 70%, 15, 10, and 5. First 70% will be for monthly expenses. The next 15% will go directly into our monthly investment. Next 10% for personal saving, and the last 5% will be for emergency, and we will not touch these 5% until we have emergency case. Inshallah, no one have an emergency case, but this is the purpose of it. So if anyone stuck to this plan, I can guarantee for him a very financial future, a very good financial future.
It is, and I think, you know, we can say that to all young people, but I know they're not going to take that advice. They're going to take a loan and get some muscle car.
Or get, this is the problem, yeah, yes.
Or get the latest, you know, video games and stuff. But honestly, invest your money, like you said, 20 years ago, because 20 years from now, you know, if you're 20, if you're 21 years old, at 40, if you've invested, you know, 20 years ago, you're going to be, mashallah, probably a millionaire by then.
Yes.
So it's always a great advice to take. With that being said, Ammar, I do want to thank you for joining us and giving us a lot of great financial advices here on Good Morning Kuwait. So thank you very much for coming.
Thank you very much.
Thank you, and thank you to your viewers for staying tuned to our talk with Ammar Alkandari. You know, I think the key message here about this conversation was very clear. You know, building our wealth isn't about chasing quick returns. It starts with understanding our finances, making informed decisions, and thinking long term. So we want to thank Ammar Alkandari again for joining us, but also you, the viewers, for staying tuned. We are going to take a break, but after the break, we're going to continue the program.